Anyone can make money in a bull market, but you need to have more than one trick to trade in any market. Here are 5 tips to help you trade more profitably using our newsletter. Number 1, understand the concept of risk-reward ratio, aka R&R. The risk-reward ratio, sometimes we call it R&R ratio, is a measure that compares the potential profit of a trade to its potential loss. It's calculated by dividing the difference between the entry point of a trade and the stop loss order. So that's the risk by the difference between the profit target and the entry point. That is the reward. Here is an example of how you calculate R&R. Let's say you buy a stock at $10 and then your stop loss is 9 and your profit target is 15. The R&R ratio is 1 to 5, which is 0.2. That means you are risking $1 to pursue a $5 potential profit. It is important to understand R&R because if your buy point moves, but your stop loss and profit target stay the same, your R&R will change and it could potentially make a trade undesirable. That is exactly why you do not chase. Number 2, never go into a trade without a stop loss. You can't control the upside reward, but you can control your downside risk. A stop loss is the only way you can control the risk element in R&R. Stocks can go much lower than you could imagine, and you can always get back into a trade later when all the technical indicators align to the upside. Here is an example that shows how important a stop loss is. CVNA, a stock that we traded before, went from the high of $377 to $19. So in reality, if you lose 50% of your capital, you will need to make 100%. Like you need to double your trade in order to just break even. So never trade without a stop loss. Number 3, have a profit-taking plan. Whatever profit you see is not yours until you take it. Profit targets in the newsletter are just estimates based on the chart. Nothing is guaranteed. You need to have a plan to take partial profit at different. Here is an example to show how you could take profit. Let's say you buy a stock at $10. Your stop loss is $9.50 and your profit targets are 12, 14, and 16. When the stock hits 12, take profit on a quarter of your position and then adjust your stop loss to 10. When the stock hits 14, take profit on another quarter of your position and adjust your stop loss to 12. And when the stock hits 16, again, take profit on some of your positions and adjust your stop loss to 14. And then leave the remaining 1/4 as runners as long as the stock stays above 14. Number 4, size properly. Whether you allocate funds evenly across all your positions or proportionally based on your outlook on the market, you need to have a consistent system. It is best not to put all your eggs in one basket, meaning you do not YOLO. Number 5, use the trading tools your online broker provides. Online brokers continue to offer a lot of trading tools to help traders execute trades better, such as real-time notifications based on conditions or technical indicators, or automated order execution, etc. Do spend time learning what they have available to you. I am a big fan of trail stop coupled with conditional order. Here is an example of how you could use trail stop. Let's say you buy a stock at 10 and your profit target is 13. You can set a 50-cent trail stop order to be triggered live only after the stock hits 12. At 12, it is not far off from the price target you have, but you can capture a pretty decent amount of profit by using a 50-cent trail stop without having to stay in front of the computer all day.